In Forex trading, risk is not something to avoid, it is something to manage. The difference between consistent traders and those who burn out quickly is not strategy alone, but how they control exposure in unpredictable market conditions. This guide explains how traders approach risk management in Forex and how to apply it in a structured, practical way. Forex markets are highly liquid and fast-moving. Price can shift within seconds due to macroeconomic news, central bank decisions, or sudden liquidity changes. Without risk control, even a few trades can significantly impact your capital. That is why experienced traders define risk before they think about profit. The goal is not to win every trade, it is to stay in the market long enough for your strategy to work. Every trade should start with one simple question. How much am I willing to lose if this idea is wrong? This defines position size and stop-loss placement. Instead of reacting after the fact, traders set clear boundaries before entering the market. This approach removes emotional decision-making and creates consistency over time. A stop-loss is not just protection, it is part of the strategy. It should be placed where the trade idea becomes invalid, not at a random distance. If price reaches that level, the original analysis no longer holds. Proper stop placement helps avoid unnecessary losses while keeping trades aligned with logic rather than fear. Position size determines how much impact a single trade has on your account. Even a strong setup can fail. By keeping position size consistent and controlled, traders prevent one loss from damaging overall performance. This creates stability and allows for long-term participation in the market. Forex markets behave differently depending on volatility and liquidity. During high-impact news events, spreads can widen and price movements become less predictable. In such conditions, traders often reduce exposure or wait for stability. Adapting risk to market conditions is a key part of maintaining control. One of the most common mistakes is trading too frequently. More trades do not mean better results. In fact, overtrading often leads to increased exposure and emotional decision-making. Experienced traders focus on quality setups rather than constant activity. No single trade defines success. Forex trading is a series of outcomes over time. By managing risk consistently, traders allow their strategy to play out across multiple trades rather than relying on individual results. This mindset reduces pressure and improves decision-making. Risk management is not about tools alone, it is about discipline. Following predefined rules, respecting stop levels, and avoiding impulsive decisions are essential for long-term success. Without discipline, even the best strategy becomes inconsistent. Managing risk in Forex is the foundation of sustainable trading. It involves defining exposure, controlling position size, and adapting to changing market conditions. The Prime Nexus Gate approach focuses on structure over emotion. In a market where uncertainty is constant, disciplined risk management is what allows traders to remain consistent and resilient. In 2026, success in Forex is not about predicting every move, it is about controlling what happens when you are wrong.